Rohr here with an early global view on Thursday, August 14th, 2014. And in fact, this is starting just a bit later than usual due to a slight technical problem this morning. It's currently 7:15 a.m. Central Time. And of course, this is a global view because we're coming back in after some very important fundamental influences, all of which that seem to paint a weaker picture of the economic activity than was previously expected. When we ask, what does all this mean to the markets? Well, right now it seems that in spite of weak economic news, the slight easing of tensions and overt, aggressive activity in the geopolitical front means that the equities can rally back up. A major part of the sell-off, which took the S&P down into testing the lower gap, the old major runaway gap in the 1904 area that it opened back at and above last Friday after ranging down to 1890 area, which was the low end of the gaps on the September contract overnight out of Thursday into Friday before opening reasonably well Friday morning. It has continued to rally again on that easing of geopolitical tensions in spite of the weak economic data. And we ask, well, could this be a bad news is good news scenario where central banks are going to be much more accommodative once again? Our answer is, well, it could be, but we don't look for the reinstatement of any QE. So, the question is, how good can bad news really be? Whereas the market has rallied back very nicely now, back above the 1938 level, which we had noted was 38 to 34 was a key on the way down. And when the market broke that, going back a couple weeks ago, it set the stage for the bigger spill down to test the 1900 area. As a matter of fact, that was 2 weeks ago today, on Thursday the 31st, that the market cracked 1955 early in the day and then broke 38, and now we're back above that. However, the higher failure level at that time was up at 1955 to 50, and as you can see, the broader channel coming in across the resistance now is up around the 1950 area with some fresh Fibonacci resistance and some failed Fibonacci support all up in that 50 to 55 area that we think is going to be the key arbiter where this market continues up or reverts back down and maybe has to go back down either to the interim support in the 1920 area or even retest the 1900 area once again. And looking at how that plays out on the intermediate term picture, it's once again getting back to some old news at this point. The stall out several weeks ago we spotted in the 1985-87 topping line and oscillator resistance led to the failure the following week, mostly on geopolitical concerns. And here's your test of that upside runaway gap from late May. As you can see, 1904, and again holding here with only modest slippage below it last Thursday before pushing back up. But here is the resistance back around the 1950 area. In fact, it was the downside, minor downside reversal from June 24th at 53 that once it was overrun had the market holding in the 1950 to just below it, gapping below it back on the 31st, put it back under pressure, and you still have a pretty good sized gap down from there that contributes to the resistance in that area. Pardon me. So, what we have here now is an S&P that's rallied back pretty nicely, but we have to question whether it's going to continue up or revert to weakness.